Hello and a warm welcome to Econoday Unplugged on Wednesday, the 4th of March 2021. Mark Penders on the US East Coast, Brian Jackson's in Sydney, and I'm Jeremy Hawkins here in London. Well, it's been an especially volatile time in financial markets since our last podcast. We said then that a battle was looming between traders and the central banks over where long-term borrowing costs were headed. And a week ago today, hostilities broke out in earnest. Just who will win this encounter is hard to say. But at this stage, I guess the markets have a narrow lead. So following last Thursday's bond market rout, the stock market slump. Monday saw yields fall sharply. US S&P 500 index post its biggest one-day gain in almost 9 months, in fact, erasing nearly all of last week's declines. Since then, things have been rather more stable, but away from COVID, the focus is still on inflation expectations, and US yields are creeping up again. Central banks, of course, are never keen on excessive volatility, and one of their groups that's been particularly proactive in trying to calm investor nerves is the RBA, which upped its bond buying to reaffirm its commitment to protecting its 3-year yield target. So, Brian, if we kick off with you first, how far do you think the RBA is prepared to go to keep yields down? And given that the Australian economy expanded more than 3% last quarter, do domestic economic fundamentals justify maintaining historically low borrowing levels in the first place?
Well, there is starting to be questions raised about that. We know that the RBA has for some months now been saying, we don't think the conditions will be met for us to, take the foot off the gas for another 3 years. So 2024 is a long time away, and they've been saying pretty clearly that they think policy rates need to be kept at this record low until then, and intimating that they'll keep on using other measures to keep rates very low up until that period. But the data is starting to look a lot better than what it was when they started with this message just a few months ago.
Right. So to interrupt you then, why, given that, as you say, the data are improving, why do they want to keep yields so low? Is it just due to the exchange rate?
That's part of it. But also, I think they obviously have their policy targets for inflation and for employment, and there's still a long way to go before I think you're going to see any real move in wage pressures. That hasn't started to eventuate yet, and so their inflation target is still looking a long way off. And so until that happens, I think they want to keep policy very supportive and accommodative, and try and get some juice into the economy as much as they can.
Interesting. Let me switch across to New Zealand then. One of the risks of keeping borrowing costs down, as we've seen a number of different countries now, and Mark can certainly chip in on that, is that the more interest rate sensitive sectors can overheat, and housing is clearly an obvious case in point. Now, last month, the Reserve Bank of New Zealand chose to reimpose loan to value ratios to help cool its housing market. Now, if I got it right, the government has actually instructed the central bank to consider the impact on housing when making monetary and financial policy decisions. So does this mean then that we're going to see potentially higher interest rates in New Zealand sooner rather than later? Does it kind of undermine central bank independence if the government's getting involved in it? And does it also mean that they're going to have to accept a stronger New Zealand dollar?
These are all
answer those in whichever order you fancy.
Well, it's always a challenge for particularly a small open economy like New Zealand to try and manage the policy mix between the exchange rate, between domestic interest rates, and the impact that has on different sectors of the economy. So that's something I think the policymakers at the RBNZ are used to managing. But you can't always meet all of your goals at the same time, and sometimes you have to be a little bit flexible on what you prioritise. And so I think at the moment, they've still got pretty severe health restrictions put in place in New Zealand. That's still having an impact on the overall economy. If things are starting to heat up in the property market, then I still think that the RBNZ is going to be trying to just get the real economy moving again. And if there's some other policy levers that they can pull to try and stop the property market getting too heated, then I think they'll be prepared to do that. In terms of independence, I'm not 100% sure what the RBNZ's specific remit on property prices is. I don't think they have a specific target for that, and so I don't think that's going to really undermine their credibility as an independent central bank.
Okay, fair enough. So what about the rest of your region then? In particular, we got in China. Obviously, folks will be interested in what's going on there. We get the National People's Congress kicking off tomorrow, I think, if I remember rightly. Is there anything in particular we should be looking at policy-wise for any kind of changes? Is there going to be more issues about tackling rising debt, or what's going on?
Yeah, that's a perennial issue, and I think that will continue to be a bit of a headache for Beijing. Over the last 12 months, obviously, they've had to ramp up spending in a lot of parts of the economy, and not necessarily in the most effective way. And that's something that often happens in China when it gets really loose on policy. It tends to have debt problems, 12, 18 months down the road. The thing about China, though, of course, is that we're right at that time of the year where we're sort of a little bit blind about how things are going there, because we don't have, the Chinese don't release separate data for January.
Yeah, right. Okay.
They combine their January, February numbers because of the impact of the Lunar New Year holidays. So it's been a while since we've actually had a good read on what's going on in the Chinese economy. That'll be fixed in the next couple of weeks when we get the numbers for the 2 months combined, and so we'll have a better idea. But if you look at the PMI numbers, they've actually been a bit of a concern. The PMI numbers are one of the few things that do come out still on a monthly basis at this time of the year, and they're all showing a pretty consistent trend of weaker conditions over the last 3 months in China.
Is that generally across the economy, or just manufacturing, or just
services? No, it's both manufacturing and services, and both the official numbers and the PM and the sort of private sector PMI numbers. So until we get a bit more clarity, it's hard to say exactly what's going on, but it's probably just some weakness in major trading partners. Europe in particular is probably having an impact. And the fact is, over that sort of 2 or 3 month period, we have had some more COVID outbreaks in parts of China.
Okay, nice one. So you cover Korea now, we're all delighted to say. So is there anything to say about that? I thought we had a fairly decent acceleration in the inflation rate as far as February is concerned. Has that got any implications? What's going out there? Is the start of a new trend, or is the central bank reasonably happy the way things are going at the moment?
I think they're happy to keep policy accommodative and sort of not too worried about inflation right now. It's still well below their 2% inflation target. It shot up, I think, from about 0.6 to 1.1% in January. That was, though, largely due to food prices. That might have been a Lunar New Year holiday surge as well in food prices. If you look at other major categories of prices, that they weren't showing any really alarming trend. So I think they're happy for the time being to keep policy pretty supportive. But they're looking okay, though, if you look at the activity numbers as well. Their PMI survey at the start of the month was pretty strong, and most of the activity numbers are tracking okay as well. And that's actually what we're seeing apart from China across the region. Actually, we're getting some pretty decent numbers. India, Japan has also been a little bit better, and as I said, Korea. So hopefully a lot of this has to do with the vaccine rollout and some improved confidence about things. But we're just probably waiting for the rest of the global economy to kick in and provide that really extra support to exporters in the Asian region.
Okay. So lastly from my side, so you mentioned about the vaccine rollout, just quickly, in terms of regional development. So how's the COVID situation going in your part of the world?
Yeah, it's kind of it hasn't really been on the front pages in the last 4 or 5 weeks, really.
Got to be good news.
Yeah, there's it's obviously still a concern, and there's I think Hong Kong and Singapore have had a few cases, and still public health restrictions in place, but it hasn't really had a huge impact, I think, on some of the numbers that are coming out at the moment. And as I said, if you look at some of the confidence indicators, people in the region do seem reasonably optimistic that vaccines will provide some real boost to the global economy over the next 6 to 12 months.
Okay, great.
I have a question, Brian. About China and official monetary policy, also fiscal policy. We have a parliamentary meeting coming up next week, and we're supposed to get a new 5-year plan. Also, there's been talk on and off, day to day, on whether or not financial conditions are being tightened there. What is the outlook? Is China going to be an outlier? Are they going to be the first one that we see that will begin to withdraw stimulus?
I think there would be interest in Beijing to do that if they could, because as I said before, they are worried about debt levels and the impact on overly accommodative fiscal policy, in particular on some of the provincial governments. But it remains to be seen whether they sort of feel they can do that. If these PMI numbers that we've had over the last 3 months, if that's indicating some renewed weakness in economic activity, then they might have to press pause on that. I mean, we do have, as you said, the MPC meetings coming up, and they tend to not necessarily limit what policymakers do afterwards. They tend to be more sort of aspirational targets for where they want things to go, particularly over the next 12 months. But if conditions do change, I think you would see policy also change pretty quickly.
Also, I had a question on the Australian bonds. They've been moving. Is it just my imagination? Have there been these, vast, gigantic day-to-day moves like 15 basis points on the 10-year and degrees like that? And when that happens, is that ordinary? Does that make the financial press in Australia? Is that like a big headline?
It does, yeah. Probably not though as much as moves in the exchange rate. That tends to get people a little bit more riled up about what's going on there. But it does obviously flow through to people's consciousness. But to be honest, obviously the most important thing for most people though is what impact that has on mortgage rates, and so that hasn't really flowed through to those at the moment.
Okay, right. Well, thanks for all that. So, Mr. Pender, talking of stimulus, we obviously get to the Fed. Now, to quote Jerome Powell from last week, the economy is a long way from our employment and inflation goals. It is likely to take time for substantial further progress to be achieved. Now, the Fed didn't seem to be overly worried by the jump in yields or indeed the steeper curve last week. But given Powell's comments, is there a kind of a limit to how far they're prepared to let these yields back up?
Well, it's funny you should say that because he made the same comments just today, and they have they're sinking the stock market. I don't think that there should be much of a surprise. Today he returned to his inflation expectations anchor for himself. It's an anchor for his own outlook on how to wage this battle. And he says that they're not going anywhere, that they're ingrained after a generation of underperforming. So he doesn't see any immediate risk. And it's interesting that inflation will brew. And he made the one-time comments that we're seeing those policymakers who want to stay dovish. They're starting to cite the same kind of evidence, and so I don't think that the Federal Reserve is really kind of moving at all toward that tapering moment. But it's interesting because the RBA we were talking about, Brian was talking about, mentioned the 3-year horizon, and if Powell didn't mention 3 years when inflation will finally hit target, that if he didn't say it last week and he didn't say it this week, he said it the week before, and actually it's all contained in the FOMC economic forecasts. So it's really no surprise. He's just underlining, where 2% hits, when it hits, or when they think it could hit within the range. But are these global central banks, you guys, you think that they're all on the same page with this, that they're all looking at each other's forecasts, and that if we look out and we stand back, there's really just kind of a centralized general view? What do you guys think?
Well, I must say, from my side, I'd say no. I think some central banks don't appear to be concerned at all about the backup in yields, but some of them, and in my part of the world, certainly the ECB is the standout character, and some of them clearly are. And I guess it comes down.
But what about their I'm talking about their inflation forecasts.
Well,
have any of them changed? Is it all? If we look at all of them across the world here, will we all see this 2%, emerging in 2023, 2024?
Well, I think
we haven't really seen much change in inflation forecast in this part of the world recently. Whether that changes though in the next couple of months, then yeah, that's definitely interesting. But it hasn't happened yet.
Yeah, sorry. Over here, I mean, it's a good question actually, because next week obviously we get the ECB meeting, and it's the quarterly meeting where they're going to update their economic forecast. So there's a lot of focus on that at the moment, because we know that the ECB isn't happy about the backup we've seen in Eurozone longer dated yields, and there's always talk about they may step up their bond purchases. But in terms of economic forecasts, and yes, we have seen a bounce in inflation coming out the Eurozone in January, but the February data showed the core rate starting to cool a little bit. And looking at the latest set of forecasts, which show for December, they effectively suggest that a policy was still too tight, because inflation still isn't getting close to this 2% medium term, so 2 to 3 year target that they're operating with. Now, for the Bank of England, when they updated their forecasts in February, they intimated that they saw, because due to the vaccine rollout, the fact it's been pretty successful over here, they did see a higher level of inflation than previously. But even so, by the end of the forecast, you're talking about it pretty well being in line with where it's supposed to be. So I think from what the central banks in Europe still appear to be saying, at least at the moment anyway, is that they don't regard inflation as being a big issue. Yes, they do see a short-term blip due to some technical factors, and obviously the bounce we've had in the oil market. But on the underlying trend, I think they don't see at this stage as being significantly different. And I guess that's one reason why they're so determined to convince the bond market, look, inflation's not going to go up a lot, therefore yields don't have to back up a lot.
Well, on that note, it seems that that's the majority view of global central bankers. But then we have the chief economist at the Bank of England. Now, last week, he said something, he was talking about inflation being the sleeping tiger that's going to stir and devour us all. Do you have any background on Andy, on Andy's history?
Well, he's actually, Andy Haldane, you say, the chief economist of the Bank of England. He's actually tended to be one of the more dovish members of the committee. Now, he does come out with various research papers, and extremely intelligent person, and doesn't always talk the standard central bank line. But it's interesting, if we go back to just a few months ago, he was the person who was touting this view that at the end of the day, the bank is much more concerned about what's happening to the UK labour market than it is about what's happening to underlying price trends. And he was a person who was actually coming out suggesting that at that stage, when the UK furlough, the employment furlough, was expected to end in April, he was talking about levels of GDP in relation to how far it should be versus pre-coronavirus times, in terms of gauging whether or not the labour market would deteriorate any further. So I think, yes, it's perfectly fair to say that inflation has been a sleeping giant for some time, but it's been a sleeping giant for so long that I think a lot of people are kind of thinking, well, what's really changed? All we've seen so far is an acceleration, certainly in some of the commodity markets, albeit a fairly aggressive one. But why have we had that? Well, part of the reason presumably is due to the COVID disruptions. We got huge disruptions in some of the global supply chains. As far as the UK is concerned, of course, that's also been compounded by all the Brexit problems with the ports and transportation and so on. So in some ways, it's perhaps not too surprising you'll get at least a sort of a temporary spike. The real question mark, I suppose, is what ultimately determines inflation. And it kind of comes down to what's happening with the labour market and wages. So unless we're going to see a big bounce in wages, I think a lot of central bankers are taking the view that what spike we do see, if we do see one in inflation, is going to be relatively short-lived.
Well,
that just reminds me. We've also had some people here in Australia are just worried about maybe a return to inflation, but it's people who have very, very long memories. We had a former Prime Minister, John Howard, come out this week, and he was Prime Minister back in the 90s, and before that he was the Treasurer way back in the 70s. So he has a really long institutional memory of when inflation was actually a problem, and he's just saying, don't assume that it's never going to come back.
Well, the 10-year note in the U.S., as we've been speaking just about, has gone up another 7 basis points here. So we're at 155 right now. And the 150 was supposed to be some kind of a psychological level, of course. So we just shot through that. So this theme isn't going away.
But if we put 155 in context, I mean,
yes.
we're about roughly where we were a year ago.
Yes, but it's yes, you're right. No, but it's a speed. It's going straight up.
Fair enough. I appreciate that, but it does seem to me that if you sort of if you've been on holiday for a year and came back, you think, oh well, what's happened to the bond market? Nothing. Yields now are where they were before. So really, all it seems to me, partly it comes down to, I think, the fact that clearly investors, markets are looking at the vaccine rollout and thinking that, well, all being well, this is how we finally get rid of this coronavirus, or at least we return to some sense of normality. And if you really believe that, then presumably yields now should be back to where they were before the coronavirus started in the first place.
Normality doesn't have all this huge amount of stimulus flowing into it from fiscal and monetary sources. So this time a year ago, it's not the same background. It's not the same, things at work in the market.
No, appreciate that. But I suppose I can play devil's advocate and say that, well, when you think about the hole which came in aggregate demand as a result of the coronavirus, had we not had that stimulus, then presumably yields would be so negative that we'd never seen anything like it in our lifetimes.
But that hole is healing. And now it went, and at least the Fed doesn't seem very interested right now. I mean, it can't go on forever if the 10-year, if interest rates keep going up. There obviously will have to be a point when then some statement will have to be made. But will the Fed start controlling the market? Will they start, bringing those yields down? And that could be a very
I agree. It's interesting. I mean, you think about what's happening at the moment. Effectively, you've got central banks saying the short end of the yield curve, which they really can control, isn't going anywhere. So Fed funds is staying where it is. Bank rate is staying where it is. Whatever the benchmark interest rate for the central bank isn't going to be hiked. So the short end's pinned. So if market inflation expectations continue to rise, then the yield curve is going to keep getting steeper and steeper and steeper. And it must raise a point at some stage whereby markets simply lose confidence in central banks. They think they're so far behind the curve that they simply don't have control of inflation, which is guaranteed to rise at some point. So it's a fascinating time in the way markets operate.
Well, it's the immediate effect on the U.S. housing market right now. We have weekly purchasing indexes from the Mortgage Bankers Association, so that's really live news, and it's 3 or 4 weeks in a row now that these indexes are going down sharply lower. They've been, of course, very, very sharply higher, but they were up like 25%, 20% compared to this time last year or a month ago, and now they're dead flat. That would be and that in a way is predicts higher interest rates in the future too, in a way. But is
that a plus factor? Is that one reason why the Fed appears to be not too concerned about it? Because you talked on various podcasts saying that this housing market is overheating. Well, is this not a means of actually, effective allowing the market to cool the housing market of its own accord without the Fed doing anything?
Yes, that's true. It's a self-balancing act.
Okay, right. Jolly good. Well, let's move along since we've been prattling for a bit. Before you finish, Mark, apart from anything else you might want to say, employment report Friday. What's going to happen?
Okay, let's see here. Well, the indications, we had a a decline in in jobless claims. That's 2 weeks now that we've seen. They declined very sharply, 111,000 the prior week, and they only rose back 9,000 on this week. And this was much better than expected. The thing is that this covers the single week at the end of February, whereas the employment report that we'll see tomorrow was sampled in the mid part of the month. So that's not going to affect expectations for the report. Excuse me, but the expectations are very mediocre. Another really soft report. Please excuse me. And let me just see here to get the latest Econoday consensus is 175. It's been going up a little bit. It's been inching up through the week. That would be for non-farm payrolls, and that would be an average, solid, good, moderate reading in a normal economy. That's not what they want now. I mean, first time jobless claims, for example, there were over 700,000. That's 3 times as much as it was before the pandemic.
Interesting. It'd be interesting if we were to get a really weak employment report, presumably tomorrow on Friday, whether or not it might actually start to quash some of these inflationary expectations. And of course, if we get a particularly strong one, then given the current focus of the market, presumably we could see yields actually move significantly higher.
But okay, what's interesting about this average hourly earnings now, I know that's an interesting topic for you, Jeremy, and with the UK. And here, a bit, that would be your standard look for inflation, very important look, but that has been so distorted now because of the absence of the proportional reduction of low-wage employment.
Same thing here. Yeah. Okay, right, moving on. Anything else you want to chip in with, Mark, before we get into Europe?
No, Powell and employment, that should do it.
Done. Good enough for me. Okay, summarise Europe then. Well, as I mentioned, the ECB has certainly been unhappy with the backup in yields over here. Over the course of the last, few days or so, we've had 3 fairly heavy-duty hitters from the central bank, and that includes President Christine Lagarde and the chief economist Philip Lane, doing their best to try and talk yields back down again. It was interesting. We had the chief economist, I should say, suggesting that the ECB is not engaged in yield curve control, in the sense, to quote, that it wants to keep a particular yield constant. What they're saying is that with the purchase program, we are trying to move the curve in a certain direction with enough force to support inflation dynamics. Well, whatever that means, I'm not really too sure. But I think the bottom line is that it does suggest that the ECB does not want to see yields move higher. And that's despite the fact we've got the entire Eurozone yield curve, at least the AAA borrowing curve, still negative out to some 17 years or so. So it kind of intimates that the ECB is looking around at what's going on in the real economy, and it's not too happy. And if you look at the recent data, you can kind of see reasons for why. I know that manufacturing's doing okay, but services, to all intents and purposes, are still in recession. There's been some negative knock-on effects from the fallout from Brexit. And in particular, the lockdowns we've got across a large number of Eurozone states at the moment has had a big impact on consumer spending. So the retail sales figures out of the Eurozone we had out earlier on today, month on month for January, they're down almost 6%. And that's the steepest decline we've seen since April of last year, in the midst of the first virus wave. And indeed, if we look at actual discretionary spending, that was down 12%. And this is just a month-on-month figure. You got a huge decline in Germany. In fact, over the last couple of months, German sales have fallen more than they did back in March and April of last year. Austria, as far as January, just picking out some of the individual states, that was down almost 17%. So all the signs are that first quarter Eurozone GDP growth is going to be negative. So that's the double dip recession that people have been musing about, almost done and dealt now. And I guess that's why the ECB at the end of the day does not want to see anything which will jeopardise the chances of the Eurozone starting to pick up some kind of steam later on. As we talked about before, the vaccine rollout, I should say, within the Eurozone is still extremely slow. It's running at about a quarter of the rate we've got in the UK at the moment, about a third of the rate we've got taking place on Mark's side in the States. And it's raising concerns that these lockdowns will be in place for that much longer. So I think, just quickly looking into next week, there is certainly speculation that we could see some additional easing from the ECB. Although my guess would be if they were to do it, it would be through this pandemic emergency purchase program that only has a ceiling. It doesn't have a monthly purchase rate. So there's plenty of room left within that at the moment. So they could quite happily come out and raise their
that at the long end? Would they target that buying?
Not specifically, I don't think. I mean, most of their, if you look at their weighted average mean duration of the bonds they're buying at the moment, it's typically around about, depends what you call long end, around about 7 to 10 years, something like that at the moment. But I think that's we get weekly data out of them, but the latest figures don't actually include the big push we had in yields at the back end of last week. So it's hard to say whether they've actually started increasing their purchases yet. But it's going to be interesting next week to see what they actually come out and say, because I suspect they'll certainly make at least some strong comments to the fact they don't want to see yields move any higher. UK, we had our budget over here yesterday, and the bottom line to that is very much that as far as the UK government's concerned, they're still most worried about the state of the real economy. Although the fourth quarter was quite good over here, we actually got positive growth, which was stronger than originally expected. The first quarter is expected to see a fairly significant decline. So the budget added, another 65 billion sterling of extra help to the UK economy this year and next. So they're not messing about. They've extended the furlough period for another 6 months. And that's important because it reduces pressure on the Bank of England, which, as you mentioned, is particularly worried about the labour market at the moment, reduces the chance of them coming out and easing again. So that should be at least a bit of a plus factor as far as the pound's concerned. Stamp duty thresholds also been extended, but there will be a big hit to potentially a big hit to UK growth once we get beyond 2023. That's when they'll be freezing personal income thresholds, and there'll also be, notably, has been one of the biggest increase in corporate taxes on corporate profits that we've ever seen. So it should be decent growth potentially. This all comes to fruition over the course of the next few years, but beyond that, say beyond 2023, there may be quite a big hit coming down. What else I mentioned? I suppose just of note, we talked a little bit about this on previous podcasts, and that's this, the move into the so-called green market and green bonds. So part and parcel of the budget yesterday was that the government will be looking to issue the best part of 15 billion sterling worth of green bonds, with a view to starting to build effectively a green yield curve. And that's the kind of move we expect to see happening more and more across Europe, because the ECB is going to be doing very much the same sort of thing. Okay, well, I guess that's pretty well it from my side.
I have a question.
Yeah. Go.
We cover these regions and all this economic data, and by flying from the seat of your pants, let's all say whether or not we see inflation as a risk. I mean, as a fundamental risk that could change the economic outlook. Now, I'm not talking about the markets. I'm just talking about inflation. So I'll say from what? Pardon me.
Sorry, over what sort of term? You're talking this year, the next 2 or 3 years, or?
Well, let's look. Yeah, well, let's look over this year, because the markets seem to be reacting very quickly here. So let's just the near-term outlook. Well, we've all kind of already agreed that there will be some kind of one-time post-COVID burst of prices. But outside of that, okay, let's call it medium term. Is there, or let's just say, is there a shift in paradigm? Is there now going to be an inflationary awakening? Is that a change in the way the whole thing goes? I will say from the U.S. data, I do not see that.
Well, I'll say from European data, particularly at the moment, I'd go along with that as well.
Yeah, I mean, I don't want to just sit on the fence and say it's hard to say, but there's no indication of it yet, of a real substantial shift in just that underlying trend that we've seen for many years now.
Right.
And it's not as if we haven't done it's not as if policymakers haven't done all they can to really create the conditions for it to happen. It's just not happening yet.
Yeah. It's just interesting. Look at what happened during the last global financial crisis. I know we've had the likes of the US pumping in a lot more money this time, but other central banks and some governments have pumped in more money than they did during the last crisis. And of course, inflation after the last crisis didn't really go anywhere at all. So it will be interesting whether or not the structure of the world has changed sufficiently that, given the amount they've stuck into the economy this time, it will make a difference, or not. Okay, good talk, I guess, as they say. So as always, we've been talking on for probably too long. So let's wrap it up there then. On behalf of Mark, Brian and myself, thanks as ever for listening. The podcast will be back next week. But in the interim, everything you need to know about the key market moving data and events can, of course, be found in the very user-friendly form of Econoday's Global Economic Calendar. We'll see you next time. Bye for now.